BigBear.ai Holdings, under ticker BBAI, closed its last active trading session on Friday, June 5, 2026, at exactly $4.14 per share, marking a decline of 13.21% for the day on a massive trading volume of over 37 million shares. This direct correction follows a massive 22% single-day breakout earlier in the week, sparked by the official launch of their tracking system in Panama. When retail traders on popular investing sites saw the news, many rushed to buy, expecting a parabolic move. Yet the true reality beneath that short-term volatility is far more intricate than a single international deployment. While the retail crowd is chasing daily swings on their Robinhood app, the institutional capital is quietly calculating whether BigBear.ai can actually transition from a low-margin government services contractor into a high-margin software business. This exact tension between what people hope the stock will become and what the financial balance sheet actually proves is where the real value lies for self-investing individuals looking for clear asset analysis. The recent movement in BigBear.ai highlights a classic market trap where a highly published headline masks structural challenges, creating a sharp drop that caught late buyers off guard. Just days ago, the market was celebrating their partnership with Narval Holding in international shipping compliance, which deployed a logistics security system across the Panama Canal port network. Because that corridor manages around 5% of all global maritime trade, investors immediately assumed this contract would translate into an absolute windfall of recurring software revenue. However, when you look closer at the institutional trading data and order flows via advanced platforms like the Interactive Brokers platform, a completely different narrative reveals itself. Large block trades showed sophisticated funds taking liquidity and trimming positions into that massive strength, completely aware that actual cash flow realization from Central American logistical operations takes quarters, if not years, to meaningfully alter a corporate balance sheet. If you were trying to figure out how to navigate these dramatic swings, looking at how the broader sector is priced can give you significant clarity. Right now, BigBear.ai trades at a highly elevated forward 12-month price-to-sales ratio near 15, which places it at a massive premium compared to the broader IT services sector. When a small-cap stock carries that kind of premium, any slight delay in contract monetization or a wider-than-expected quarterly loss causes immediate panic, which is exactly why we saw that 13% drop on Friday. The company recently posted its first quarter financial results, reporting revenue of $34.44 million, which barely beat consensus estimates of $33.6 million. More importantly, they logged an operating loss of over $23 million for the single quarter, demonstrating that their current scale is still burning through capital to maintain its operational footprint. For individual brokerage account holders managing their own capital, this signals that the stock is behaving purely as a high-beta vehicle driven by headlines rather than an established enterprise with stable, predictable earnings. Please take a brief second right now to leave a quick update down in the comment section. Comment below how many shares of BigBear.ai you currently hold in your portfolio, or if you are simply tracking it on your watch lists for a safer entry point. Understanding the structural makeup of BigBear.ai requires looking past the daily chart noise and examining how it fundamentally operates. Founded originally in 1988 and later restructured through private equity before coming public via a special purpose acquisition company, the enterprise operates primarily out of McLean, Virginia. They specialize in what they define as decision intelligence, building custom analytic software designed to organize massive unstructured data pools into clear operational insights. Unlike popular consumer companies like Apple stock or Tesla stock, which rely on mass-market product adoption, BigBear.ai sells highly specialized platforms to high-consequence environments. Their historical core has always been the United States federal government, specifically providing defense analytics, cyber vulnerability testing, and logistics modeling for the Department of Defense and various intelligence communities. The business model relies heavily on long-term federal procurement cycles, which provides a massive backlog but creates lumpy, unpredictable revenue growth. Their current total backlog sits near $282 million, supported heavily by massive wins like a recently disclosed $53 million classified sole source contract within the intelligence community. They have also actively expanded their product portfolio through acquisitions like Pangiam, which brought in digital identity, biometrics, and border verification capabilities that allowed them to secure the recent Panama tracking project. Furthermore, they are trying to scale their secure generative software product named Ask Sage, which counts NASA and the Army Intelligence Command as early users. Yet despite these impressive government relationships, the economic reality is that a significant portion of their business is still tied to low-margin human capital consulting and custom engineering services, rather than pure, scalable software infrastructure. This structural reality creates a clear divergence when you look at how different market participants approach the stock. For instance, an investor using a premium service like Schwab Intelligent Portfolios or automated online investing algorithms might see the high volatility and negative earnings per share of -84 cents and automatically flag the stock as a high-risk asset.
On the flip side, an active trader using a Robinhood stock trading setup might view the low nominal share price under $5 as a perfect opportunity to capture fast percentage gains on speculative momentum. This creates an ongoing tug of war in daily trading volume, where long-term institutional stability is frequently overwhelmed by short-term retail speculation, leading to sudden, violent retracements like the one we just witnessed at the end of the week. When planning a long-term strategy for this specific asset, evaluating how it positions itself against direct competitors is absolutely critical. BigBear.ai constantly finds itself competing for federal budget allocations against massive diversified defense giants like Leidos Holdings and pure-play data analytics warehouses like Palantir Technologies. While Palantir has already achieved massive commercial scale, positive net income, and widespread institutional inclusion across major indices, BigBear.ai is still fighting to prove it can operate profitably without relying on continuous equity dilution or debt issuance. For anyone managing their own investments through platforms like Fidelity Investments, managing this specific downside risk means recognizing that BigBear.ai does not yet possess the capital scale or the pricing power of its larger industry peers, meaning its execution margins will remain thin for the foreseeable future. Looking forward, the future outlook for the company depends entirely on two contrasting scenarios that investors must weigh carefully. In the bullish scenario, the recent commercial deployment in Panama serves as a legitimate proof of concept that allows the company to rapidly win additional commercial logistics and maritime security contracts across global trade hubs, effectively breaking their heavy dependence on slow-moving U.S. government budgets. If they can successfully scale their digital identity and biometric platforms into international commercial sectors, their gross margins will expand dramatically, causing Wall Street analysts to re-rate the stock as a true software enterprise rather than a government consultancy. This shift would likely drive massive institutional accumulation, providing sustainable upward pressure on the equity. Conversely, the bearish scenario hinges on the persistent risk of contract execution delays and ongoing capital burn. If federal defense spending faces domestic legislative gridlock, or if international commercial rollouts face bureaucratic hurdles, BigBear.ai could easily see its revenue growth stall, while their fixed engineering costs continue to rise. Because the company is currently unprofitable, any prolonged slowdown in cash conversion would force management to raise additional capital, potentially diluting current shareholders at an inopportune time. Furthermore, as larger competitors like Leidos and Palantir continue to embed their own advanced analytics tools deeper into federal frameworks, BigBear.ai faces the constant threat of being crowded out of larger procurement opportunities, capping their long-term growth potential. To cleanly summarize what we are seeing here, the market's current reality has once again checked over-expected expectations. The excitement surrounding international logistical expansion is a notable milestone, but the reality shown in the recent 13% drop reminds us that quarterly capital burn and structural service dependencies cannot be ignored. BigBear.ai remains a highly speculative high-beta vehicle that requires careful position management, whether you are tracking it on a premium individual brokerage platform or executing short-term swings on a mobile app. The underlying technology holds clear value within national security and global trade infrastructure, but until the underlying financials show a sustainable path to clear profitability, the stock will continue to reward the patient analytical observer while punishing those who buy blindly into the peak of the headline hype.